Welcome back, folks. Our today's agenda is to learn how to find highest probable order blocks in any market. As you know, in the market there are a lot of ranges and candles, so it's not very easy thing to find the highest probable order block that will give you the ultimate setup. But in this video, I'll give you certain set of steps and conditions that will always lead you to highest probable order block. So with almost saying, let's jump right into it. For the starters, let's give the short explanation of order blocks for those who are very new. So basically, an order block is a change in state of delivery of algorithm from buy side to sell side and sell side to buy side. It is represented by the last set of consecutive candles after stop rate at a higher time frame key level. Now, these last set of consecutive candles can be bullish as well as bearish according to the market we are looking at. Now, what are the high probability order blocks? There are two must-met conditions for the high probability order block. These conditions are, very first one, which is very important. This is sufficient stop rate before the aggressive price action. See, before we jump any further, I want to let you know that price needs a certain fuel to go aggressively toward a certain level. And that fuel is a liquidity, which we get from sufficient stop rate. Whenever you expect an aggressive reversal or aggressive continuation, always look for a stop rate. Thus, the fuel price needs to continue in a certain direction. Our second condition is a higher time frame key level that supports our idea of order block. If we are looking for a bullish market, we need a bullish higher time frame key level that suggests the higher prices. And same goes for the bearish market. If we are looking for the bearish prices, we need a bearish higher time frame key level that supports our order block. They might seem too simple rules to skip the entire video, but believe me, it's not that easy to get the grip of these concepts. These two rules, along with the order block formation, can change your entire trading perspective. When I was a new trader, when I actually gradually started to grow, I backtested these things thousands of the time. These things repeat, but you have to get the grip of these things to understand where and how they will actually form. See, if you don't know how they will form, you will always miss the big move. So first of all, let's look at the bearish order block. Our very first condition was a higher time frame key level. We need a bearish higher time frame key level for a bearish order block. Then, when our very first condition is met, we look for our second condition, which is price tapping into the higher time frame key level. Now, this is the order block formation. You need to skip it because all of you know how the order block is formed. That's very basic. What we are discussing in this video is that what is high probability order block. For a high probability order block, price needs to be in a higher time frame key level. Now, this higher time frame key level can be an old high right below the price, or a fair value gap, or anything else, a higher time frame order block, maybe, or breaker block. But for starters, let's say it's a fair value gap. Then we look for the price to take sufficient stop rates. Once price took sufficient stop rates, in this case, we are looking for bearish order block. So price is going from buy side liquidity to sell side liquidity. It's the change of state of delivery of algorithm from the buy side to sell side. That's the bearish order block. Once we took the sufficient stop rate, our second condition is met. Now, whatever order block is going to be created in this zone, that's going to be high probable. And we will take our entry from that order block. But let's say we continue this. Then we look for the order block formation. This is very basic. All of you know how an order block is formed. We look for an aggressive move opposite to the early market direction with the short-term stop rate toward our actual market direction. Now, these candles act as bearish order block. For the bearish order block, these will be the bullish set of candles. And then we look for the retracement. And after retracement, we finally enter in the trade to catch this aggressive move toward the sell side liquidity, which is going to be way too big than you think. Now, let's proceed to bullish order block. As I told you, our very first condition is higher time frame key level. We look for the highest probable order block at a higher time frame key level. Now this key level can be on any time frame which you prefer to be highest time frame. For me, I look for daily and 4 hour or sometimes even 1 hour. But most of the time I look for 4 hour higher time frame key level or daily higher time frame key level. After our very first condition is met, which is higher time frame key level, then we look for the price to enter in this zone and react off of it after taking these stop rates, which is in this case is sell side liquidity, and we are going from sell side to buy side. This is the definition of bullish order block. We go from sell side liquidity to buy side liquidity. Our second condition is also met as we took this all low, sell side liquidity. There's enough fuel for price to aggressively react from it and go bullish now. After that, we look for the order block formation and then mark the last set of consecutive candles as our bullish order block. That's right here. All the consecutive candles entering in this zone after this aggressive move, we mark them as our bullish order block, and then we wait for the retracement. As soon as price retraces back, we look for our opportunities on much lower time frame if you prefer, or we can enter on the time frame where this order block is forming. And after this, we take our entry, keep our SL below these consecutive candles right here, and then shoot toward our drawn liquidity, which is buy side in this case. So that's the formation of bullish order block. A bullish order block is the change of state of delivery from sell side to buy side. And a high probability bullish order block will always have a higher time frame key level and a sufficient stop rate. Now, let me tell you why your order blocks were not working, or anyone who is suffering the problem of failing the many order blocks. You were always skipping the very first two rules which make the highest probable order blocks. See, I have seen many traders who just skip the higher time frame key level and sufficient stop rate and then jump right into the order block formation and then entry. See, that's the biggest mistake you can do, because order block form at key level and sufficient stop rate. The thing you see when you just jump into the order block formation and then entry is the form of algorithmic manipulation that algorithm do to gather some liquidity from the new traders in the market. And when you mix it up with the higher time frame key level and sufficient stop rate, that's the opportunity for the smart money traders. And we as institutional traders look if that's aligned with our higher time frame analysis and then shoot for the entry. That's what we do. We always consider these two rules, a higher time frame key level and a stop rate. If I'm entering in a trade where I look for the order block, I always look for a higher time frame key level and a sufficient stop rate. Otherwise, I'm just using any other PDA or any other logic. Now let's look at the examples. Our very first example is a bullish order block. This is USD JPY monthly chart. So we are looking for a higher time frame key level from this zone that will cover this price movement. I actually call this price movement inside my free Telegram, where I'll send the analysis and the level which price is most likely to target. So let's add some imitation to make it obvious. You see, this is the premium wick. A premium wick is a PDA that is supported by another PDA or a higher time frame stop rate, and its 50% is the level where we look for the reversal or the retracement to react from. You see, price has respected this level aggressively right here, and we've also taken the sell side liquidity below these monthly lows. So that's also a higher time frame key level below a monthly low. We have two key levels that supports the idea of formation of bullish order block. Now let's go to our daily chart. After the monthly chart, we go to daily chart. Here we are. We have our same higher time frame key level right here. We are below a monthly low. After our very first condition is met, we look for the second condition, which was sufficient stop rate. As we are below a monthly low, we obviously took a lot of sell side liquidity right here, and we have a lot of fuel to jump higher. So we also took the liquidity right here on the daily chart and some short-term stop rate as well. After this, we look for the order block formation, and as I told you, an order block is the last set of consecutive candles at a higher time frame key level after sufficient stop rate. So where's the last set of consecutive candles? It's right here. You see, that's our order block. In this case, it's bullish. We are going from sell side liquidity to buy side liquidity after hitting a higher time frame key level. It's the change of state of delivery of algorithm from sell side to buy side. With this news filter, price gave us an entry right inside this inversion fair value gap, and we targeted our buy sell liquidity right here. We could have executed right here, here, and then took some position of right here and left some to go higher. Our next example, this is Bitcoin versus US dollar. It's the daily chart, the most recent price action after the Trump's victory. This is the Trump candle. You can see we are looking at this price movement right here. And guess what's this? A type of order block that is less probable, but it works very amazing when the market is too aggressive to go higher or lower. Right here. Let's mark it off. It's higher time frame key level. That's daily roadblock after the stop rate. Now let's go on hourly chart and look for the order block. Here we are on our hourly chart. We have a higher time frame key level right here, and we have done a lot of sell side liquidity right here. You see these equal lows right here, here, here. That's a lot of sell side liquidity to shoot higher toward our drawn liquidity, which is buy side. We are going from sell side liquidity to buy side liquidity. That's the bullish order block. After our two conditions for the highest probable order block are met, which is a higher time frame key level and enough stop rate, we look for the order block formation. And as I told you, after price react aggressively from the level which is on higher time frame, it's the key level. We look for last set of consecutive candles and mark them as our order block. In this case, that's this. These two candles enter in our higher time frame key level, and they are consecutive before this aggressive price movement. We break the swing right here, take the market structure shift, then price comes back into the fair value gap, gives us nice entry, shoot higher, gives us another entry, and then targets the buy side liquidity. We could have executed right here, here, took something off, and then left some. Here's the biggest picture. You see, the movement on the Bitcoin versus US dollar hourly chart was actually a market maker buy model. After hitting this higher time frame key level, which was daily roadblock, and taking the enough sell side liquidity, we were targeting this original consolidation right here. And there's a lot of low resistant liquidity as well. Price gives us nice opportunities and then shoots for the buy side liquidity and then continues higher. Our next example, this is euro dollar. It's for the bearish order block. We are on our forward chart. This is also the most recent price action. This was the trade when Trump was about to win. You see, we have done the market structure shift right here after taking the enough sell side liquidity, and then we shoot lower with these aggressive candles. Now we are expecting price to go even lower because this is the form of continuation after price is going to respect this volume imbalance and these fair value gaps. So we mark the fair value gaps that are most likely to be respected by the price. In this case, I was looking for this one because when our price is too aggressive to go lower, it will always choose the nearest fair value gap to react from. It could have gone right here, I won't mind, but on the lower time frame, we saw some amazing reactions, so we choose this fair value gap. So let's go on the lower time frame. This is 15-minute chart. After the 4-hour chart, we go to 15-minute chart. You can see this is the 50% of that fair value gap consequent enhancement, and that's our higher time frame key level, which is bearish fair value gaps end. After price hit the higher time frame key level, we look if price has taken enough buy side liquidity to create a bearish order block. We see it right here. Price has taken 2 old highs before this move. That's our second condition for the highest probable order block. After this, we look for the order block formation, which is being confirmed by this aggressive price leg, which did the market structure shift right here, and then we mark the last set of consecutive bullish candles as our bearish order block. Right here, we are going from buy side liquidity to sell side liquidity. It's the change in state of delivery of algorithm from the buy side to sell side. That's the bearish order block. We are also in our fair value gap, so it's the highest probable trade. We could have executed from here. And the last example, this is USD JPY 60-minute chart. This was the trade that I took, and I also sent inside my free Telegram. You can check it out right there. You can see we have taken enough buy sell liquidity right here, broke the market structure here, and then created this bearish PPR. Now, a bearish PPR or balanced price range is the price range where we see this phenomena happening. There's a wick right here and a wick right here and the body in between them. That's a bearish PPR. I would explain it much greater details in upcoming videos. For now, let's just say this is our higher time frame key level, and we are looking for bearish prices after price react from this level. We are on lower time frame. This is 5-minute chart from hourly to 5-minute. You see, this is our higher time frame key level, bearish PPR. This is our very first condition, and we have already taken a lot of buy sell liquidity as well. Right here, here, here as well. After this, we look for the order block formation. Now, there's something I want to tell you before you spot this candle and tell me that I have marked the wrong order block. These set of candles, all of these, including this bearish candle, is an order block. Why, you say? Because this candle could have been a bullish candle because of few pips. These are few pips. This could be because of the spread or anything else that broker does. That doesn't matter. You can just ignore this candle and consider these as our bullish order block. We mark it as a bullish order block and then look for the other PDWs to align with it. In this case, fair value gap, and then execute toward our drawn liquidity. Right here, took something off and all position off right here. So that was all about the order blocks. Once again, I want to remind you that the reason why most of the order blocks new traders mark fail is because they skip the very first two rules of the highest probable order blocks. They just look for the formation of the order block and then enter in the trade. They don't look for the higher time frame key level nor for the sufficient stop rate. But from now on, I want you to look for the higher time frame key level, then stop rate, and then the order block formation. You will always follow these sequence of the actions. That's it for this video. Stay sharp, stay safe.